Hey everyone, welcome back to Ethos Investing. My name is Dan. If you're new here to the channel, I hope to provide you with the confidence and tools to lead, motivate, and remain resilient during your investment journey. In today's episode, we are going to be talking about why people interested in improving their financial outlook often struggle to start their investing journey. We will also explore an investment strategy to overcome these issues, and finally examine some potential funds that take the thinking and fear out of it all. With that said, let's jump into the video. The big question in all of this is what causes people not to invest in the stock market. And I think to have a better understanding of that, we have to dissect the psychology of investing. There seems to be 4 reasons that drive people not to invest in the stock market. The first reason is lack of knowledge. There seems to be a myth circulating around that only intellectually gifted individuals can do well in the market. There also seems to be a misconception that paying a financial advisor is better than making your own investment decisions. The second reason why people don't invest in the stock market is lack of capital. They feel like investing is too expensive and out of reach for them. The third reason is lack of time and/or motivation. In today's age, people are often consumed by their 9-to-5 jobs. Additionally, people oftentimes delay jumping into the market by stating they'll do it at a later date. Invariably, these folks never invest. And the fourth reason why people don't invest in the stock market is fear of losing everything. Many see the stock market as being way too risky, and others don't think people make money by investing. In fact, the most recent Federal Reserve survey on consumer finance in 2016 found that only 51.9% of households own stock. Of this 52%, most participated in the market via retirement accounts like IRAs and 401ks. Only 26.9% own shares of stock, while another 18.9% invested in some sort of fund. The remaining portion had managed investment accounts, trusts, or annuities. The 2019 study should be out sometime later this year. If you feel this content is going to help you on your investment journey, please hit the like button so I know you are following me. Now that we've examined why people are hesitant to invest in the stock market, I hope to lead you to make the leap into the market through the utilization of an excellent investment vehicle for folks just getting started. The great Warren Buffett once said, "The trick is not to pick the right company. The trick is to essentially buy all the big companies through the S&P 500 and to do it consistently and do it in a very, very low-cost way." Based on Mr. Buffett's wisdom, what investment vehicle affords you this opportunity while taking the thinking and fear out of investing? The answer is clear: an ETF. What is an ETF, or exchange traded fund? It is exactly what it sounds like. It is an investment fund that is traded on a stock exchange. Think of an ETF as a basket of assets that could be stocks, bonds, commodities, just to name a few. The funds can include 50, 100, or even thousands of different assets within them. ETFs have increased in popularity over the course of the last 15 years. Now let's take a look at some of the advantages associated with ETFs. The first advantage is that most ETFs don't have a minimum, meaning you can start investing with very little money. This includes fractional shares, if that is offered by your broker. The second advantage is diversification. ETFs allow you to invest in baskets of securities, minimizing your risk and thereby requiring less time monitoring your portfolio. The third benefit is tax efficiency. ETFs tend to generate less tax liabilities than similarly structured mutual funds. And the fourth advantage I will mention is liquidity. ETFs are more liquid than other investments as they are bought and sold like stocks throughout the day. And the last advantage is that most ETFs offer lower expense ratios. Now, let's examine 3 quality ETFs that people new to investing should consider. All right, everybody, we've just dropped into ETF.com to examine our first of 3 funds, ticker symbol VTI, or Vanguard Total Stock Market ETF. This is a fan favorite amongst the investment community. It closed today at $151.34, and ETF.com gives it a fit score rating of 99 or A. VTI has also been around for quite some time with an inception date of 24 May 2001, so it's quite established. It also has an extremely low expense ratio of only 0.03%. Additionally, VTI has a distribution yield of 1.84% and is also extremely diversified with 3,474 holdings in the fund. This makes it extremely diversified and very attractive to new investors. Next, we'll check out VTI's performance. The fund had a 3-year annualized return of 8.68%, a 5-year annualized return of 8.31%, and a 10-year annualized return of 12.54%. Finally, let's examine VTI's top 10 sectors and holdings. 3 sectors, technology, healthcare, and financials, make up nearly 60% of the fund's holdings. VTI's top 10 holdings account for 21.9% of the fund and include Microsoft, Apple, Amazon, Facebook, Alphabet Class A, aka Google, Johnson & Johnson, Alphabet Class C, Google again, Berkshire Hathaway, Visa, and Procter & Gamble. The second fund we'll examine is ticker symbol VOO, or Vanguard S&P 500 ETF. It closed today at $275.04 and has an ETF.com fit score rating of 96 or A. VOO has an inception date of September 7th, 2010, so it's nearly 10 years old, and it also has an extremely low expense ratio at only 0.03%. VOO has a distribution yield of 1.95%, and holdings for the fund are near 500. Next, we'll look at VOO's performance. The fund had a 3-year annualized return of 9.37% and a 5-year annualized return of 8.97%. It did not yet have a 10-year annualized return because it's 9 years and change old. Finally, let's examine VOO's top 10 sectors and holdings. 3 sectors, technology, healthcare, and financials, make up nearly 60% of the fund's holdings. VOO's top 10 holdings account for 25.85% of the fund and include Microsoft, Apple, Amazon, Facebook, Alphabet Class A, Alphabet Class C, Johnson & Johnson, Berkshire Hathaway, Visa, and Procter & Gamble. The third and last fund we'll examine is ticker symbol VYM, or Vanguard's High Dividend Yield ETF. It closed today at $78.64, and ETF.com gave it a rating of 96 or A. VYM has an inception date of November 10th, 2006, so it's been around for a while, and a slightly larger expense ratio than VOO or VTI at 0.06%. VYM has a distribution yield of 3.57% and 395 holdings, which means it's a bit less diversified than VOO. Next, we'll look at VYM's performance. The fund had a 3-year annualized return of 3.03%, a 5-year annualized return of 5.11%, and a 10-year annualized return of 10.92%. Finally, let's examine VYM's top 10 sectors and holdings. 4 sectors, healthcare, consumer non-cyclical, financials, and technology, make up nearly 62% of all the fund's holdings. VYM's top 10 holdings account for 27.93% of the fund and include Johnson & Johnson, JP Morgan Chase, Procter & Gamble, Intel, Verizon, AT&T, Pfizer, Merck, ExxonMobil, and PepsiCo. These investment vehicles are ideal for most of the population. The key is to invest consistently in them over time, whether that be every week, bi-weekly, or once a month. The ultimate benefit is that you really don't need to think about them all the time, all while building your nest egg. Hopefully, this leads you to finally take the leap into the market, motivates you to change your financial future, and affords you long-term resiliency through the utilization of a nearly stress-free investment vehicle. Warren Buffett said it best when LeBron James asked him for investing advice. Buffett stated, "Somebody like LeBron should just make monthly investments in a low-cost index fund. It makes a lot of sense. Owning a piece of America, a diversified piece bought over time, held for 30 or 40 years, the income will go up over the years, and there's really nothing to worry about." Remember, I am not a financial advisor. The opinions expressed in this video are solely for educational and entertainment purposes only. Any stock purchase I show in videos should not be considered an investment recommendation. Investing involves risk, and you should do your own research. For investment advice, please seek the counsel of a financial advisor. As always, lead the way, motivate others around you, remain physically and mentally resilient, foster a positive investing ethos, be pragmatic, and have fun achieving your goals. Thank you so much for watching, and see you next time.